You're sitting there, scrolling through your phone on a Tuesday afternoon, maybe waiting in line for coffee or hiding out in your car during lunch, and you check your portfolio. Everything is green. Actually, no, it's beyond green. It's practically glowing. Your retirement account is up 20% this year. That random tech stock you bought on a whim 2 years ago has basically tripled. And you're starting to get that feeling. You know the one. It's that quiet, sneaky sensation where you genuinely start to believe you're just good at this. Like, maybe you should do this full-time. Maybe you should quit your day job, open a brokerage account with margin, and just ride this wave all the way to early retirement on a beach somewhere. And honestly, why wouldn't you feel that way? Every single financial headline is cheering you on. Every podcast you listen to is talking about how the economy is bulletproof. Your neighbor who doesn't know a single thing about balance sheets just made 15 grand on some cryptocurrency meme coin and is currently shopping for a jet ski. It feels like the rules of the game have permanently changed in your favor. My name is Zach, and I spend way too much time thinking about money, financial psychology, and why some people seem to effortlessly build wealth while others stay stuck in the same financial patterns for decades. And the reason I get so obsessed with this stuff is because I've noticed something that happens right at the peak of that feeling, that intoxicating, euphoric, I'm a genius phase. There is a sequence of events, a psychological shift that rolls through the culture like a deep, invisible tide, right before the bottom falls out of everything. If you can learn to spot it, and honestly, it's incredibly obvious once you know what to look at, it completely changes the way you protect your money, how you view risk, and honestly, how you sleep at night when everyone else is losing their minds. So, what actually happens before a crash? Because it's never just a random lightning strike out of a clear blue sky. It's a process. The very first thing that always happens, and I mean always, going all the way back to the Dutch tulip mania in the 1630s, is what I call the death of the skeptic. You have to understand that markets normally function with a baseline level of friction. There are always buyers, but there are also always doubters. There are people saying, hey, this price-to-earnings ratio doesn't make sense, or this company isn't actually making any money yet. Those skeptics act like the brakes on a speeding car. They keep things grounded in some version of reality. But right before a crash, the skeptics don't just get quiet, they get humiliated. Think about it. If you were warning people about tech stocks in 1998, you looked like an absolute fool for 2 whole years while everyone else got rich. If you said housing prices in Miami were disconnected from wages in 2005, people literally laughed in your face. The skeptic gets priced out, emotionally defeated, and eventually, they just give up and join the party. I remember talking to a guy back in 2021, a very conservative, value investing type, who finally broke down and bought a bunch of high-flying, unprofitable tech stocks. He told me, I can't keep fighting the tape. My clients are leaving me for crypto brothers. That was the exact moment the clock started ticking. When the people who usually say no start saying yes, the market has run out of new, rational money. It's running entirely on fumes and fear of missing out. Why does this matter to you? Because the moment you hear yourself justifying a bad investment by saying, well, everyone else is doing it, you are the market's last source of fuel. The actionable takeaway here is brutally simple. If your own internal skeptic has gone quiet, force them to speak. Write down one reason, just one, why the trade you're about to make could fail. If you can't do it, you're in too deep. The second thing that happens is this bizarre, collective amnesia regarding risk. It's like the entire financial world suffers a temporary lobotomy when it comes to the concept of losing money. You start seeing financial jargon get completely warped to make dangerous things sound safe. In the lead-up to the 2008 crash, they bundled together toxic, subprime junk loans and slapped a AAA rating on them. AAA. The same rating given to U.S. Treasury bonds. Right before the dot-com bust, we were using eyeballs and page views to justify billion-dollar valuations for companies that had zero revenue. Today, we just relabel debt as leverage and speculative gambling as yield farming. I was at a barbecue a few summers ago, right around the peak of the last crypto and meme stock run, and I overheard someone's uncle, who, by the way, was a retired plumber, explaining to a teenager how to use decentralized finance protocols to yield farm stablecoins. He had no idea what he was talking about. He was just repeating words he'd heard on a YouTube ad. But he sounded incredibly confident. And that's the thing. The language of high finance gets co-opted by everyday people, and it creates this illusion of safety. It makes a casino feel like a bank vault. For you, the takeaway is to strip away the jargon. When someone tries to sell you an investment, or you're looking at one yourself, strip it down to kindergarten language. What do I actually own? How do I actually make money from this? And what is the exact mechanism by which I could lose every single dollar I put in? If the answer to that last question is murky, walk away. Just walk away. Okay, so we've lost the skeptics, and we've forgotten what risk means. The third piece of the puzzle is what I like to call the sideline scream. This is when the media and the culture shift from simply reporting on wealth to actively weaponizing your anxiety about not having it. You'll see magazine covers with headlines like, "How 25-year-olds are making millions while you sleep," or "The New Rules of Money, Why Saving is for Suckers." It's no longer just about making money, it's about the social penalty of not making money. It taps into our deepest, most primal insecurities about keeping up with the tribe. I remember feeling this personally during the NFT boom. I'm a reasonably rational guy when it comes to money, I've seen enough cycles to know better, but even I had a moment where I was looking at a digital picture of a monkey and thinking, am I the idiot here? Am I going to be left behind? It's an incredibly powerful, visceral feeling. Your brain literally processes FOMO as a physical threat. The media knows this. The algorithms know this. They feed you stories of ordinary people getting extraordinary results to bypass your logical brain and go straight for your amygdala. Why does this matter? Because the sideline scream is designed to make you act emotionally, and emotional money always finds its way into the pockets of rational money. The actionable advice here is to build a concrete financial moat before the scream starts. If you have an emergency fund, automated investments in boring index funds, and a clear long-term plan, the sideline scream just sounds like white noise. You can look at the jet ski buying neighbor and genuinely feel happy for him, rather than feeling a desperate need to copy him. The fourth thing that happens, honestly, this is the one that fascinates me the most, is the total collapse of the narrative. In a healthy market, the price of an asset is somewhat tethered to a story about its underlying value. You buy a stock because the company is growing its profits. You buy a house because people need places to live and rents are going up. But late in a cycle, the price detaches completely from the narrative, and the narrative becomes circular. People start buying things simply because they are going up. The justification for the price going up is that the price went up. It's a tautology. Why is this coin worth $100? Because it was $50 last week, and someone will pay $200 for it next week. During the housing bubble, the narrative was, housing prices never go down nationally. That wasn't an economic fact, it was just a projection of the recent past painted onto the infinite future. You see this in the physical world, too. You know a market is peaking when you see totally irrational luxury purchases happening en masse. When people are buying boats, second homes, or obscure luxury cars using home equity lines of credit because the house will pay for itself. I have a friend who works at a high-end marina in Florida, and he told me that right before the 2008 crash, they had a 3-year wait list for boat slips. People were buying million-dollar boats they didn't have time to use, just to park them in the water as floating status symbols. When utility is entirely replaced by status, the end is incredibly near. For you, the takeaway is to always have a non-circular reason for owning an asset. If your only reason for holding something is, someone else will buy it for me for more, you are playing musical chairs, and the music is about to stop. The fifth thing, and this is where it gets really dark, and a little bit personal for a lot of people, is the blurring of the line between investing and gambling, specifically through social validation. We've always had gamblers in the market, but what's different now is the gamification and the socialization of it. When you buy a call option on an app that throws digital confetti at you, and then you go to a Reddit forum or a Discord server where 10,000 people are cheering you on, your brain releases dopamine in the exact same way it would in a casino in Vegas. But it's worse, because it feels intellectual. You aren't pulling a slot machine lever. You're looking at a chart. You're part of a movement. You're sticking it to the hedge funds. I fell into a mild version of this trap years ago with options trading. I remember sitting at my desk, buying out-of-the-money Tesla calls right before an earnings call. My heart was pounding. I was refreshing the screen like a maniac. And when it printed money in about 3 minutes, I felt like a god. But when I lost money on the exact same trade 3 months later, I didn't feel like a god. I felt sick. I felt shame. And because it was hidden behind a trading app on my phone, I didn't have to face a casino dealer or a bookie. It was just me, alone with my phone, quietly transferring my wealth to someone smarter than me. If you are engaging in financial behavior that gives you a physical adrenaline rush, you are not investing. You are entertaining yourself at your own expense. The fix for this is to institutionalize your boredom. If your investment strategy is so boring that you don't want to check your phone, you are probably doing it right. Set up auto drafts. Buy diversified funds. Rebalance once a year. Treat your investing like you treat your plumbing. You want it to work perfectly in the background without you ever having to think about it. So, we've covered the psychological shifts. But there's a sixth element, a structural one, that always happens right before the floor drops out. It's the expansion of leverage to the absolute fringes of the economy. Leverage is just a fancy word for debt used to buy assets. And in a healthy market, leverage is tightly controlled. You have to put 20% down to buy a house. You have to have a certain amount of capital in your brokerage account to trade on margin. But as a bubble inflates, the gatekeepers get greedy, and the rules loosen up.
Why?
Because there's so much money to be made in fees from pushing more people into the game. In the 1920s, you could buy stocks with 10% down, meaning you were borrowing 90% of the money. In the mid-2000s, we invented ninja loans. No income, no job, and no assets required to get a mortgage. They were literally giving six-figure loans to people who couldn't prove they had a dime to their name. Today, we see leverage creeping into the system through zero-commission trading, infinite margin on certain apps, and the proliferation of personal loans being used to fund lifestyle or speculative accounts. When you see lending standards drop to the point where literally anyone with a pulse can get a massive loan to buy an asset, the crash is already baked into the cake. It's just a matter of timing. For you, the practical advice is to actively deleverage your own life before the market forces you to. Pay off your high-interest debt. Don't use margin. If you have a variable rate mortgage or a HELOC, look at your exposure. Be the only person on your block who owns their stuff outright. It's not sexy, but when the tide goes out, it's the only thing that keeps you from drowning. The seventh thing we see, and I think this is the most universally relatable one, is the rush of amateur money into the market. There is a famous saying by a historic financier, Jesse Livermore, that goes something like, "The stock market is never obvious. It is designed to fool most of the people, most of the time. And the ultimate fool is the pure amateur who arrives at the very end of the party." You can actually track this using public data. Right before a major top, you see massive inflows into retail trading accounts. You see a spike in Google searches for how to buy stocks or what is Bitcoin. I remember looking at Google Trends data in early 2021, and the search volume for Dogecoin had surpassed the search volume for stock market. Let that sink in for a second. A literal joke coin based on a Shiba Inu meme was commanding more attention from the American public than the entire engine of global capitalism. That is a screaming, blaring siren. When your hairdresser, your Uber driver, and your grandmother are all giving you stock tips, the distribution of buyers is completely exhausted. There is literally no one left to buy. The actionable takeaway: use the shoeshine boy rule. If you are getting unsolicited financial advice from people who have no business giving financial advice, it is time to quietly head for the exits. Not panic, just quietly reduce your risk. And finally, the eighth and last thing that always happens right before the crash is the invention of a new paradigm. This is the ultimate psychological trap. It's the belief that the old rules of economics, math, and history no longer apply because of some new technology, new policy, or new societal shift. In the late 90s, it was, the internet changes everything, so profits don't matter. In the mid-2000s, it was, global capital flows and financial engineering have eliminated the business cycle. More recently, it was, the Fed will never let the market go down, or, technology has made inflation impossible. The new paradigm story is incredibly seductive because it has a tiny grain of truth to it. The internet did change the world. The Fed does have immense power. But a grain of truth is used to justify a mountain of absurdity. Human nature doesn't change. Greed doesn't change. The math of compounding debt doesn't change. Whenever you hear the phrase, "this time is different," from a mainstream financial voice, you should immediately translate it in your head to, "We are running out of excuses for these absurd prices." For you, this means anchoring yourself to history. Read financial history. Read about the South Sea bubble. Read about the panic of 1907. When you see the patterns repeating, it strips away the magic of the new paradigm and reveals it for what it is, just the same old human madness wearing a new outfit. So, let's pull all of this together. What do we do with this information? Because I don't want you to walk away from this thinking you need to liquidate your entire life savings and bury it in the backyard. That's not the point at all. The point is awareness. When you see the skeptics getting fired or mocked, when you see complex debt being sold as safe yield, when your family group chat is suddenly full of stock tips, when the magazines declare that saving is dead, and when everyone around you is using borrowed money to buy things they don't need, you don't need to panic. You just need to wake up from the trance. You need to remember that markets are deeply, profoundly psychological. They are just mirrors reflecting our collective greed and fear. What matters in your real life isn't beating your neighbor's return by 2% this quarter. What matters is building a financial foundation that can survive the inevitable storms. Because the crash isn't the tragedy. The tragedy is being forced to sell your life savings at the bottom because you were over-leveraged, overconfident, and unprepared. If you have cash, if you have no high-interest debt, and if you own fundamentally sound assets, a market crash isn't a disaster for you. It's actually a fire sale. It's an opportunity. The hardest part of all of this isn't the math. It's not the Excel spreadsheets or the asset allocation models. The hardest part is having the emotional courage to stand still while everyone around you is running wildly in one direction. It takes guts to be boring. It takes discipline to look at a euphoric market and say, "I have enough." So, take a look at your own financial life today. Not with panic, but with quiet, honest self-reflection. Are you taking on risk because it makes mathematical sense for your 10-year goals, or are you taking it on because you're afraid of looking foolish? Are you invested in things you actually understand, or are you just holding on to shiny objects and hoping someone else will pay more for them tomorrow? You don't need to be a genius to build wealth. You just need to be stubbornly, relentlessly rational in a world that is constantly going crazy. Protect your downside, keep your costs low, ignore the sideline scream, and let time do the heavy lifting for you. You'll be amazed at how far you can go, just by having the patience to do very little when everyone else is doing everything.